Introducing Silver Biotics, the preferred colloidal silver supplement of the doc. See silverdoctors.com for details and special promotional offers today, including a specially formulated 30 parts per million, only available from the doc and other healthcare professionals.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, after a big rally Thursday that took gold $100 off the 1320 low we saw in April and back over the critical $1,400 level, which the cartel had been capping gold for several days in numerous attempts to clear it. And we saw silver spike up through 23 as well. Both metals were treated to a really classic waterfall raid today on Friday's open, as well as ending the week today. Friday today, the 31st, was the end of May. It was a pretty clear capping effort for both gold and silver on the part of the cartel to get a monthly close under 1,400 in gold and back below the 23 for silver. Gold really is still within its uptrend line from the lows placed in mid-April of 1,320. As well as a $22 level continues to hold a strong support for silver. So what's your take on the metals action over the past week as well as today, Eric?
I think it's been really constructive. It's easy to get scared out of positions when all this volatility is going on, and it's really hard to hold on. But when one looks at the precious metal space from both the insurance value aspect of holding a portfolio position as well as speculating on decline on the dollar or higher inflation rates in the future or more pressure in the bond market, which we spend quite a bit of time actually talking about in our write-up section, and we encourage people to take a look at that because the charts are pretty telling as far as what's going on in the long bond interest. There's really no change to the long-term fundamentals, and we've been reiterating this for the better part of the last month, and Asian demand continues to outpace the paper selling that we see in the West. The physical demand in coming out of Asia is on a 2-for-1 basis as far as what we see selling in the Western markets on a paper basis. There's even continuing indications that there's just not enough supply to meet existing order requests, particularly now in Singapore. So there's no way this can be considered a start of a bear market. And as far as both the insurance value of holding gold and silver is concerned, as well as the prospects of taking positions strictly for the interest of speculation in an attempt to profit, both theses are solid as far as I can see. There really is no reason to panic, and the markets are beginning to turn around when it comes to even paper gold priced on the COMEX. I mean, one look at the chart shows this, and silver has been trading pretty much sideways, but nonetheless holding 22. And as we talked about in our last show, the fact that the cartel was not able to entice further short selling by hedge funds on that telltale crash Sunday evening roughly 2 weeks ago, with the bounce back almost in lightning fashion in silver on that following Monday, just goes to show that the market is signaling that the long line of sellers has pretty much diminished in terms of hedge fund interest. And meanwhile, over on the commercial side, when you look at things like today's COT report for Tuesday's closing data, previous days, 7 days prior to last Tuesday, it continues to show a picture of the J.P. Morgans of the world going long gold. So, I mean, if the commercials are supposedly the smart money, and they're going long gold, what does that tell us? I mean, all of the signals that we're getting are contrary to the messaging that the media would like us to believe with respect to a bull market that has died. It's been a lot of volatility. It's been really painful to hold on, but everywhere I look, I see indications that the bottom is in. I mean, it's certainly possible to see the cartel attack again, and at the same time, it's probably not going to happen, frankly, because it costs them a lot to attack further, and that was the significance of that failed crash when silver bounced off like a rocket from its $20 level on an intraday basis about 2 weeks ago. When you look at the bond market, when you look at precious metals equities coming under very significant accumulation, when you look at physical demand in Asia trumping paper selling in the West, all of these indications are clearly showing that the bull market is not dead and we're just marking time before we begin the next upturn.
Touch on your statement about the COT data, the COT report today on Friday, indicating that the JP Morgans and the bullion bankers are continuing to move to the long side. The COT numbers, particularly in gold, are just astonishing today. The bullish ratio for the commercials has now surpassed the 2008 high. Went and looked back on December 2nd of 2008, commercials held in gold 177,000 shorts and 83,000 longs for a bullish ratio of 32%. As of today, May 31st, which is as of Tuesday's data, the commercials are now short 231,000 contracts in gold and long 172,000 for a bullish ratio of 43%. So just to let that sink in for a moment, the commercials are now 33% more bullish on gold than they were on December 2nd of 2008. While the specs have continued to pile on shorts, really the big smart traders and the bankers are the most bullish that they've been during the entire gold secular bull market. So it's pretty astonishing. For as much as gold and silver has been hammered, Eric and I were just talking a little bit on air. Eric has always been a big proponent for those who already have a fundamental physical position in gold and silver for the miners, the gold and silver miners, and they're just the sentiment in the gold mining section bounced off of absolute zero, I think it was, in the past week, and I'm seeing levels in some of the miners that really even surpass what we saw in the 2008 lows. So what are your thoughts on the miners right now, Eric?
I forget who it was that reported that zero statistic, but any number of that extreme is a little weird. But most certainly, if you look at things like the Hobart Digest's ranking of newsletter writers in the gold space and their perspectives on gold and silver, they are at the lowest level of bearishness, or excuse me, the lowest level of bullishness that has been recorded in this entire bull market period. And in fact, having the highest level of newsletter writers actually recommending short positions in both the bullion and the stocks. So if you look at indications of statistical momentum and relative strength for equities in terms of like RSI, they clearly bottomed out a couple weeks back. And if you look at volume that's beginning to flow into the gold mining space, it's really telling. There's definitely a lot more upside volume, on balance volume, on the buy side, and that suggests that longer-term interests for institutional money players and the more wealthy who are paying attention to what's going on in the markets are basically buying when there's blood running in the streets. I mean, people pay attention to sectors that have been down and out, and the smart money tends to buy when the majority of the herd is running in the opposite direction. Bullion tends to lag to some extent historically what we see going on with precious metals equities, and it's usually a telltale sign when the equities begin to percolate higher in advance of the bullion. And you can see this in particular in silver. I mean, silver has been pretty much trading sideways, as we noted before, but if you look at the equities, I mean, you pull up a chart for pretty much any main silver producer that you can think of, and you'll see that for the most part, we've already seen some pretty strong bounces. So it is yet one more indication that this summer is going to probably surprise people. At the worst case scenario, we'll probably have bullion trading slightly higher, but I suspect we'll may even in fact see 10-20% appreciation in both gold and silver over the summer months, and then that would in fact accelerate as we move further into the year with budgetary issues coming into the fore, the increasing yields in the bond market on the long end putting pressure on the overall economy, and all of the confluence of factors when it comes to geopolitics. I mean, it's pretty crazy going on right now in the Middle East, and there's just a lot of factors that are coming to play that point to higher prices in bullion, and there certainly is a lot to be said for accumulating the mining shares at this point, because on a relative basis, they've seen far more carnage than bullion's price decline, and they tend to have a heck of a lot of leverage when it comes to the upside. So if people in our audience are interested in doing some speculative investing above and beyond the insurance value of owning bullion, now is the time to consider positions in equities. And there certainly are a lot of great values out there.
The price action in gold, but particularly in silver, I wanted to touch on an interesting statistic here that Eric has pulled up in his research. Eric's discovered that going back to really October of 2012, when the big decline started for the metals, just like we saw today, the big down day in silver to close the week on Friday, there's been 35 regular Friday COMEX sessions and closings since October 1st, and out of those 35, 25 of them have seen prices down for the day, or over 71% of the time. And really, there's been quite a few large drops on Fridays as well. So the cartel has really been working overtime to cap the metals into the weekly close, to continue basically the management of the sentiment, is how I look at it.
Exactly, yes. It is indicative of cartel footprints, and somebody could look at this statistic by itself and say, well, okay, so in the beginning of October we saw a decline in the general prices of bullion, so you would expect to see a greater percentage of days on a decline on a specific day of the week. But in truth, when you actually look at the context of that data combined with the overall picture of trading throughout the entire week, and how days in terms of their patterning follow, which I actually did not have the time to include in this week's report. But if you examine things like what happens on a typical Tuesday, well, statistically it's very strange, but Tuesdays tend to have something like 60-70% positive days for gold and silver, and here we have Fridays that are down 71% of the time. So,
and we have the COT reports on Tuesday, so there's incentive to let the market rise on a Tuesday.
Well, yeah, there's that. There's also the fact that when it comes to setting expectations over the course of a weekend, there's no better time to paint the tape than to hit it hard on Friday, because that can offer the opportunity to follow up with the typical cartel crashes that they try to attempt to do on Sunday, thinly traded hours before Asia and London are in their main trading periods. And this type of pattern happens over and over again, to the point where statistically anybody who would look at the probabilities of those occurrences can only conclude that there's something fishy going on here. But I won't rush to push these numbers under Bart Chilton's nose. I mean, plenty of people have shown him these kind of things before, and frankly, the mainstream isn't really interested in looking at this kind of stuff. But interestingly enough, the ability of the cartel to just do whatever it pleases has taken a step up since October 1st, and this latest period of their management of these prices has been far more so out in the open. I mean, the noticeability of these statistical patterns are such that you can only conclude that they frankly just don't care that people can see that their footprints are there for anyone who cares to look. I think to some extent that's a reflection of the hubris of the policymakers behind the cartel. They really think that, for the most part, no one's going to really care that they're managing the markets the way they do, because they're getting away with it for all of these years, and they figure they can continue to get away with it. But as I note, with the bond market backing up, the manipulation efforts are going to run their course through time, and then eventually fundamentals are going to control the situation and begin to give spankings to anybody who believes that they can control the movement of mass money over the long term. I mean, markets the size of the bond market are huge, and while the Fed has joined other central banks and pumped in trillions of dollars into the markets to try to warehouse all of this bad paper in the mortgage-backed securities market, and in the United States, taking down 70% of the issuance of long-term bonds in the last 6 months or so. That can't go on forever. There are limits to how much money the Fed can print. And as we run up against those limits, the bond market's going to start creaking and moving interest rates higher. And I believe that that's what we're seeing right now. So, Ben Bernanke may not be able to get out of Dodge fast enough. I suspect that this stuff is coming down in the latter part of this year.
He's doing his best.
Yeah, he's trying. But for the sake of history, I hope that he gets recorded as the scoundrel that he is.
Listeners, a quick update here on the physical supply situation, particularly in silver. Demand has begun to pick up a little bit this week. The generic rounds from private mints, like the large private mints that make, like, for example, the Indian rounds or the Buffalo rounds or those private products, premiums are holding really at about double of what they were prior to the big April takedown. But the shortage is lessening. One of the large private mints actually has generic rounds live now in stock. A couple of them are still maybe a couple of weeks out, but the supply situation shortage has eased significantly there. And also the national mint coins, the Silver Eagles, are available either for a current delivery or up to a week out for most of the wholesale distributors. There's still a couple that are probably still 4 to 6 weeks out, and the premiums really held about the same in the Eagles and Maples this week. Maples are also live to about a week out on the wholesale side, and the same thing for the Philharmonic. So the premiums are continuing to slowly creep down on the mint products like the Silver Eagle and the Silver Maple, but they're holding steady at about double what they were prior to the April takedown on the generic 1 ounce round. So I wanted to provide our listeners an update on that on the physical side of the market. Another month has come and gone. We have May in the rearview mirror too now, and we're heading to the hot summer months, and we suspect we might have some good bullish moves in both gold and silver over the summer. Eric said a little while ago that he could see 10 to 20% on the upside in bullion this summer, and I think that's definitely a very good possibility and potential, particularly with later in the summer the debt ceiling crisis and a further U.S. downgrade looming on the horizon. So for Eric Dubin and the Doc, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.